Section 1. The opening. If you were born before 1958 and you are currently collecting Social Security benefits, there is a real possibility that the Social Security Administration is sending you a lower payment than what you are legally supposed to receive, and not because of a technical glitch or any wrongdoing, but because of a claiming decision you made at the very moment you applied for benefits. A decision that the majority of older Americans made without fully understanding its lasting consequences, one that locked in a reduced monthly payment for the rest of your life. The Social Security system includes several provisions that are specifically connected to your birth year, and these provisions influence how your benefit is calculated when your full retirement age falls, what you are entitled to receive as a spousal benefit, and whether you can go back and claim benefits for months you never collected. Seniors born before 1958 fall right at the crossroads of multiple overlapping rules, some of which work in your favor, and some of which were completely missed when you originally filed. And together, these provisions can account for a gap of anywhere between $200 and $600 per month between what the SSA is currently paying you and what you are actually owed under the law. This video is going to walk through exactly which provisions apply to your situation, who qualifies for a higher payment, and the precise steps you need to take to submit a claim with the Social Security Administration before certain windows close permanently. Section 2. Channel Introduction. If you are new to this channel, subscribe right now because Professor Kyle Pomelo puts out new content every single week covering Social Security rules, tax strategies, and government programs that directly affect seniors and retirees, all completely free in plain English and with nothing to sell. So hit subscribe and the bell so you never miss a video that could put more money in your pocket. Section 3. Two groups who think this does not apply to them. Before getting into the details, there are two groups of people who are already convinced this does not apply to them, and both groups are wrong. The first group is the senior who filed at 62 or 63, accepted the early reduced benefit, and now believes that decision is permanent and cannot be changed. But in many cases, that belief is simply not accurate because there are specific situations where seniors who filed early can request a recalculation, and these situations are tied directly to earnings history, spousal benefit interactions, and a rule called the earnings test adjustment that the SSA is legally required to apply automatically, but frequently does not apply correctly. The second group is the senior who waited until full retirement age or later and believes they are receiving the maximum benefit they are entitled to. But that assumption may also be wrong because the SSA calculates your benefit using your top 35 years of inflation-adjusted earnings, and errors in Social Security earnings records are far more common than most people realize, meaning that if you have never compared your Social Security earnings statement to your actual work history line by line, you have never confirmed that your benefit was calculated correctly. Section 4. Why the SSA sends you less without telling you. So why would the SSA send you less than you are owed without telling you? The Social Security Administration processes tens of millions of claims through an automated system that applies the rules it is programmed to apply based on whatever information exists in your file. And it does not check your earnings record for accuracy. It does not flag cases where a required post-filing adjustment was never applied. And it does not send you a letter explaining that a provision exists that could increase your payment. It calculates a number, assigns it to your account, and sends you a check in that amount every single month. And that check will stay exactly where it is indefinitely unless you take action to review the underlying calculation and request a correction. The reason underpayments happen is straightforward, because the SSA system depends entirely on the accuracy of your earnings record and the completeness of its own post-filing adjustment process. And when your earnings record contains an error, whether it is a year of wages reported under a slightly different name, a self-employment period where taxes were paid but never properly credited, or a period of work where an employer failed to correctly report your income, the system calculates your benefit on incomplete data and arrives at a lower number than the law requires. And when a post-filing adjustment is triggered and the SSA fails to apply it, the underpayment continues month after month with no warning and no correction. Section 5. About the host. My name is Professor Kyle Pomelo, and I have spent decades studying federal benefit programs and the gap between what the law entitles American seniors to receive and what they actually collect after going through a system that is not designed to maximize their benefit on their behalf. I have watched seniors recover months of retroactive underpayments after a single earnings record correction, and I have seen spousal benefit recalculations add $180 to $300 per month to a payment that had been fixed for years. And these recoveries do not require an attorney, but simply require knowing which form to request, which record to review, and which specific question to ask at the SSA office. And that is exactly what I am providing today. Section 6. Overview of what is being covered. Here is what is being covered in this video. 4 specific provisions that disproportionately affect seniors born before 1958, which are the earnings record accuracy issue, the earnings test adjustment, the spousal benefit recalculation, and the delayed retirement credit verification. And for each one, you will learn who it affects, what the SSA is required to do that it frequently gets wrong, and the exact steps to request a review, followed by 2 bonus points on the retroactive payment window and the 1 document you must obtain before any of these reviews are possible. Section 7. Point 1. The earnings record error. Most seniors assume the SSA's record of their lifetime earnings is accurate because Social Security taxes were withheld from their paychecks for decades, but the withholding was accurate, while the recording of that withholding in the SSA's database is a separate process with a measurable error rate. And the SSA has acknowledged in congressional testimony that its master earnings file contains inaccuracies affecting a significant percentage of accounts. Your Social Security benefit is calculated using a formula applied to your average indexed monthly earnings, known as the AIME, which comes from your highest 35 years of inflation-adjusted income as recorded in the SSA's master earnings file. And if any year of your actual earnings is missing, understated, or credited to a different Social Security number due to a name change, a clerical error, or an employer reporting mistake, your AIME is lower than your actual work history warrants, and your monthly benefit is permanently reduced as a result. Common sources of earnings record errors include self-employment periods where Schedule SE was filed but earnings were never properly posted, employment under a maiden name that was never reconciled after a Social Security card update, employers who used an incorrect Social Security number on wage reports, and military service earnings subject to special crediting rules that were never applied. For the lower-income senior, a single missing year that understates lifetime earnings by $18,000 can reduce your monthly benefit by $40 to $80 permanently, and recovering that year is worth $480 to $960 per year for life, plus retroactive recovery of the underpayment. While for the higher-income retiree, the most impactful errors typically fall in your peak earning years, where an employer reporting mistake or self-employment crediting issue can meaningfully reduce your AIME calculation. The catch is that the SSA will not check your earnings record on your behalf. The review must be started entirely by you, and the window for correcting certain errors can shrink as underlying wage records become harder to obtain over time. So the one action to take right now is to log into your My Social Security account at ssa.gov, download your complete Social Security statement, go to the earnings record section, and compare each year's posted earnings to your actual income using tax returns, W-2s, or any income records you have kept. Then write down every discrepancy, because that list is the foundation for your earnings record correction request. Section 8.2. The earnings test adjustments. Seniors who filed before full retirement age and kept working know the earnings test reduced their benefit because the SSA withholds $1 for every $2 earned above the annual limit. But what most of those seniors do not know is that when they reached full retirement age, the SSA was legally required to recalculate their benefit upward to credit them for every month benefits were withheld due to the earnings test. And that recalculation is supposed to happen automatically, but frequently does not happen correctly. Under Social Security regulations, when a beneficiary reaches full retirement age, the SSA must apply an adjustment of reduction factor, which is a recalculation that increases the monthly benefit to account for months when payments were withheld. And for every 12 months of withheld benefits, the monthly payment increases by approximately 6.67%, meaning that for a senior whose benefits were withheld for 18 or 24 months, this recalculation can add $100 to $250 per month permanently. For the lower-income senior who filed early and worked part-time, if you reached full retirement age and did not notice an increase in your monthly payment, the recalculation may not have been applied correctly, and the SSA's own quality control reviews have identified this as a recurring source of underpayment. While for the higher-income retiree who kept working after filing a missed adjustment on a $2,400 monthly benefit can mean $150 to $250 in permanently lost monthly income, which adds up to $1,800 to $3,000 per year, plus retroactive recovery from the date the adjustment should have been applied. The catch is that the SSA does not send a notice explaining the earnings test adjustment or confirming it was applied, and the adjustment appears as a change in your deposit amount that most people attribute to a cost of living increase rather than a recalculation. So the only way to confirm it was correctly applied is to request a benefits calculation statement directly from the SSA, and the one action to take right now is to call the SSA at 1-800-77-21213 and request a benefits calculation statement showing the earnings test adjustment applied to your account at full retirement age, asking specifically whether an adjustment of reduction factor was applied and what the exact dollar amount of that adjustment was. And if the representative cannot confirm, it requests an in-person appointment at your local SSA office to review your complete benefit calculation record. Section 9.3. The spousal benefit recalculation. Many married seniors believe their spousal benefit was calculated correctly at filing and is fixed permanently, but in some cases it was not calculated correctly, and in other cases, a change in the higher-earning spouse's benefit after the spousal benefit was established should have triggered an automatic upward adjustment that the SSA never applied. A spousal benefit is calculated at up to 50% of the higher-earning spouse's primary insurance amount, which is the benefit they would receive at their full retirement age. And if the higher-earning spouse's benefit was later recalculated upward due to an earnings record correction, a delayed retirement credit adjustment, or a post-filing earnings recalculation, the spousal benefit should have been recalculated upward at the same time. And when the SSA fails to apply that spousal recalculation automatically, the lower-earning spouse continues receiving a payment based on the old lower figure indefinitely. Additionally, seniors born on or before January 1, 1954, which is a subset of the before 1958 group, were eligible for a strategy called restricted application that allowed them to claim only the spousal benefit while their own retirement benefit continued to grow. And this strategy was eliminated for younger beneficiaries, but remains valid for those born on or before that date, meaning seniors in this group who did not use the restricted application at filing may have left significant lifetime benefit value unclaimed. For the lower-income senior whose primary benefit source is a spousal benefit, if your spouse's benefit was ever recalculated and your spousal benefit was not adjusted at the same time, you are receiving less than the law requires. And for the comfortable retiree born before January 1st, 1954, you should confirm with the SSA whether the restricted application was available to you and whether it was used. And if it was not used and you were eligible, speak with a Social Security benefits counselor about what options remain. The catch is that spousal benefit recalculations triggered by changes to the higher-earning spouse's record are not always communicated to the lower-earning spouse, and the SSA's notification practices for secondary benefit adjustments are inconsistent, meaning the lower-earning spouse may have no way of knowing the recalculation was required unless they specifically ask. So the one action to take right now is to request a benefits verification letter from the SSA for both you and your spouse. Compare your spousal benefit amount to 50% of your spouse's primary insurance amount as shown on their letter. And if your spousal benefit is less than that 50% figure and you filed at full retirement age, request a formal benefit recalculation in writing using Form SSA 795. Section 10.4. The delayed retirement credit verifications. Seniors who delayed filing past full retirement age know they earned delayed retirement credits, which is an 8% annual increase for each year of delay up to age 70, and most assume those credits were correctly applied. But that assumption is generally right and not universally so, and a delayed retirement credit error is among the largest single differences on any Social Security benefit statement. Delayed retirement credits build up at 2/3 of 1% per month, or 8% per year, For each month, a beneficiary delays past full retirement age up to age 70. So for a senior with a full retirement age benefit of $2,000 per month who delayed 3 full years, the correct benefit is $2,480 per month, and a calculation error that misses a single year of credits reduces that benefit by $160 per month or $1,920 per year permanently. The delayed retirement credit check is a straightforward math calculation for both income groups because you need 3 numbers, which are your full retirement age, your actual filing date, and your primary insurance amount at full retirement age. And the difference between your filing date and your full retirement age expressed in months multiplied by 2/3 of 1% gives you the exact credit percentage that should have been applied. And you simply compare that to your current benefit to see if the numbers line up. The catch is that the SSA's benefit verification letter shows your current benefit amount, but does not always show the underlying calculation in a way that makes checking it straightforward. And getting those underlying numbers requires a specific request. So the one action to take right now is to contact the SSA and request a detailed benefit calculation breakdown showing your primary insurance amount, your full retirement age, your filing date, and the exact delayed retirement credit percentage applied to your benefit. Then verify the math yourself, and if the credit percentage applied is lower than what your delay warrants submit a written recalculation request using form SSA 795 and attach your own calculation showing the difference. Section 11, Bonus 1, the retroactive payment window. When the SSA corrects a benefit underpayment, whether from an earnings record error, a missed adjustment, a spousal recalculation, or a delayed retirement credit error, it is required to pay the corrected amount going forward and to recover the underpaid amount going back in time. And for earnings record corrections, the SSA will typically recalculate your benefit from the date you first became entitled to receive the correct amount based on the corrected record, which for years of ongoing error can mean a lump sum retroactive payment covering the full underpayment period. For most post-filing adjustments, the standard retroactive window is 6 months under SSA policy. Though in cases involving SSA administrative error, the agency has the ability to extend retroactive payments further, and documenting that the error was the SSA's failure to apply a required adjustment rather than your own failure to act is the key to getting back as much as possible. Always request your retroactive payment in writing because a verbal agreement with an SSA representative creates no payment obligation, while a written request with supporting documentation creates a formal record the SSA must respond to, and that can be appealed if denied. Section 12, Bonus 2, the one document you must request first. Before you can identify any of the issues covered in this video on your own account, you need one document the SSA does not send automatically and that most people have never requested, which is your complete Social Security earnings record and benefit calculation statement, also called your Social Security statement. And you can access this online at ssa.gov by creating or logging into a My Social Security account. Download the full statement and not the summary, because the full statement includes your year-by-year earnings record going back to your first year of covered employment, your estimated benefit amounts at different claiming ages, and the primary insurance amount used to calculate your current benefit. And you should review every year of earnings against your actual income records, looking for years where the posted amount is 0, significantly understated, or missing entirely. Note your primary insurance amount and verify it against the benefit you are currently receiving, adjusted for any early filing reduction or delayed retirement credit, because this document is the foundation for every correction request, every recalculation request, and every retroactive payment claim covered in this video, and you should obtain it before you make any calls to the SSA. Section 13, Bringing it all together. The Social Security Administration calculates your benefit based on the information in its system, and it does not check that information for accuracy. It does not proactively identify cases where a required adjustment was not applied, and it does not tell you that a provision exists that could increase your payment, so it sends you a check for the amount its system calculated, and the check will remain at that amount indefinitely unless you review the underlying calculation and request a correction. The seniors who receive the full benefit they are owed are not the ones who trusted the system to get it right automatically. They are the ones who downloaded their earnings statement, compared it to their actual work history, asked the SSA for a detailed benefit calculation breakdown, and filed a written correction request when the numbers did not match. And that process takes a few hours, but for many seniors born before 1958, it is worth $200 to $500 per month permanently, plus retroactive recovery of years of underpayment. The message of this channel is always the same. These systems process millions of accounts with automated calculations. The errors that occur are not intentional, but they are systematic, and they correct themselves only when the person whose money is at stake knows what to look for and asks the right questions. And you now know what to look for, so ask the questions. Section 14, the closing. Before you close this video, do one thing and send this to one person in your life who was born before 1958 and is currently receiving Social Security, whether it is a parent, a sibling, a neighbor, or a friend. Because it does not matter whether they receive $900 a month or $2,400 a month, since the provisions covered today apply across every benefit level. And the person you are thinking of right now has almost certainly never reviewed their Social Security earnings record against their actual work history. One review prompted by this video could recover thousands of dollars in retroactive underpayments and add hundreds of dollars per month to a fixed income for the rest of their life. And that is worth more than almost any gift you could give. And that is what this channel is here to do. In the next video, the one IRS form that eliminates up to $500,000 in capital gains tax when you sell your home will be covered. A form your real estate agent will never mention because it is a tax document and not a real estate document, and the IRS does not require you to file it unless your gain exceeds the exclusion threshold, meaning most seniors who sell their home never file it, and most of them did not need to pay the tax they paid. So stay tuned for that one.